definitely running out of time. I mean, we have an awful long way to go in order to call anything much of a rally. So even for the people who are bullish, and you know, I like to feel bullish when I can, but you know, there's nothing really exciting to look at here. We still have tax loss selling. I mean, just as an example, look what's happened to Tesla in the last couple of weeks, and I know we're going to talk about that. But I would like to point this out because I did what I would call an informal poll, meaning every time I've watched CNBC over the last week, I have put people who speak, like us, in two columns. The ones who are very defensive and those who are bullish. And there are many check marks on the defensive side, almost none on the optimistic side. Almost every strategist
for good reason, though, right?
Or market player.
For good reason, though,
I understand
right?
that. But however, if you go back in time and you look what the prognosticators and the experts say at the end of the year about what they expect for the following year, they're almost always wrong. It's not necessarily a good bet to say, I'm going to stick with the consensus, what everybody is saying to do right now. I feel that people have gone too negative. There's too much negativism. And
that is a very fair view. That is a fair view, and one that is shared by one Ed Yardeni, who I mentioned it the other day. It's like, look, I could come up with 500 reasons why I should be negative now, because every single person, other than Jim and a few others, is negative. But that's reason enough to think that there might be a contrarian view that could come to fruition next year. History is on the side of suggesting that a down year is not followed by another down year, although maybe this time Rob, in fact, is different. I don't know if you've thrown in your own towel on this idea of any kind of rally to finish the year. Santa Claus rally, by the way, is supposed to be the last 5 of the year and then the first 2 or 3 of the new year. So we have some major work to do if we're going to put anything together, unless, Rob, you think the wall is just simply too high to scale.
Well, we definitely think Santa Claus got run over by the reindeer, Scott. But I would tell you it's best not to read too much into this week's market activity. You have to wait until early next year as we get into earnings season, first 2 to 3 weeks of January, and we get fourth quarter 22 EPS. But more importantly, we get guidance. Companies' guidance about the health of demand, their ability to navigate an uncertain environment, meaning how will they defend margins. And the street is still expecting 2023 EPS to grow at 3 to 5%. To $234. We think that's way too optimistic. And we think it's going to be likely that we come in at 220 on the high end of the range and 200 on the low end of the range. The first implies no recession in 23. The second implies a mild recession. And remember, the market is not the economy. We could still have broad economic growth, continue to be resilient, as Jim points out, but see earnings flat to down and margins falling. And as margins fall, pricing power fades. Look at Tesla, look at Nike, talking about discounting, with costs remaining elevated. And so markets are expensive. We think it's very likely that sometime in the first quarter, we retest those lows. Of course, if the Fed pauses, of course, negative positioning matters for kind of brief rallies and recoveries. But without the support of the Fed, not the pause of the Fed. Without the support of the Fed, we don't think that you're going to see the broad markets valuations have to be a ceiling. And so there's going to be dispersions between winners and losers, and the winners are those that can execute. And so price matters, execution matters, and that's where we're placing our bets.